we should be able to have as per our block model paper. I want to take you guys through what you must be very good at whenever we are talking of advanced financial management. Remember, it's always about the strategy that you adopt that will help you to basically pass this paper on a first attempt. Financial management is always a very slippery paper, not because that it is quite hard, no. It is simply because you find that, number one, we have small but many formulas. Then you'll also realize that for financial management that is advanced, the concept or questions will always tend to relate. Whatever that you handle in the first task, assuming is A, it will affect you directly in part B. So therefore, that needs you to be very, very accurate and also to be quite a person who is basically, maybe if I can say, attention to details, right? So in this case, I'm going to give you a strategy. The best strategy that you can use to basically handle advanced financial management and pass it on a first attempt. So you'll find that the beauty part with financial management advanced at this level, basically we are talking of only 9 topics. So these are the topics that ideally are in advanced financial management. Topic number 1, of course, is advanced capital budgeting. Advanced capital budgeting. Advanced capital budgeting. This is our first topic and a very crucial topic and very important, because if you analyze your papers, you'll find that majority of the concepts actually, they'll come from topic number 1. So it is in topic number 1 that you will be expected, my good students, to have a knowledge of aspects of incorporating risk. That is, of course, uncertainty capital budgeting or investment decision. Talk about the concept of sensitivity analysis, which is very key. Talk about utility analysis. We'll be talking of the concept to do with the common capital budgeting pitfalls. All these are the elements that should be expected to basically understand in topic number 1. After doing topic number 1, we'll talk of topic number 2. So this is topic number 2. This was T1, topic 1. This is topic number 2. Topic number 2 is all about portfolio theory and analysis. Portfolio theory and analysis. Portfolio theory and analysis. So again, you'll find that portfolio theory and analysis, actually this is amongst the backbone of advanced financial management. Remember the concept that you did at your basic level. At least you should be having that knowledge for you to apply the concept here very accurately. So you'll find that portfolio management is also very key for the purpose of your exams, and it is also very key for the purpose of understanding the whole concept of advanced financial management, all of it. That should take us to topic number 3. Topic number 3. Talk about what we now refer to as advanced financing decisions. Advanced financing decisions. Advanced financing decisions. That should be basically in topic number 3. So what will you be expected to cover in advanced financing decision? At this point, my good students, this is where we normally tend to talk over the concept to do with the analysis of breakpoints. These are where we normally tend to talk of aspects to do with Modigliani and Miller, right? Remember Modigliani and Miller? Also, this is a point whereby we should also be able to talk about the concept of other concepts, of course, in advanced financial management, like concept to do with CAPM, talk about WCC, talk about APV. All these items are what will be expected basically to understand in this topic, which you are referring to as advanced financing decisions. Remember, that's so different with what? Advanced capital budgeting. So in that case, this aspect, you did it at your basic level, financing decisions. So what we are doing here, basically, and of course, advanced financing decision is kind of expounding what you did at our basic level. So that one will also be very key. Then talk about topic number 4, mergers and acquisitions. A very interesting topic. Topic number 4, we're having mergers and acquisitions. Talk about mergers and acquisitions. So mergers and acquisitions, basically, it is also a very key component in advanced financial reporting because it is at this topic that you'll be expected basically to understand the concept of valuation, or rather the concept of acquisitions and mergers. Talk about the concepts of takeovers. Remember the aspect of poison pill, right? What happened between when Elon Musk was acquiring Twitter, right? Poison spill, poison spill, poison spill. We'll also be talking about aspect to do with understanding why mergers fails, and so many concepts, very interesting concepts under mergers and acquisition. So for that case, my good students looking at topic number 5. Topic number 5 basically will be expected to cover the aspect to do with the corporate restructuring and reorganization. Corporate restructuring, corporate restructuring and corporate restructuring and reorganization and reorganization and reorganization. So these are what will be expected to cover here: corporate restructuring and reorganization. Also, quite important topic basically in our quest to pass this advanced financial management. So what this is what I want us to have in mind. We have remained with the other 4 topics. But my good students, you see these topics that we've listed? These topics that we've listed here, right? These topics. These are the core topics that you just have to have at your fingertips. Core topics. Of the 100% of what is going to be tested, like 70% will come from this area. Of all that you're going to be tested in your exams, 70% will come from these topics, the first 5 topics. So that is to say, this is a must know topics. As at the end of the day, you must be having the concept of these topics at your fingertips. Because look at this case, talk of like 70%. Imagine 70%. These are literally marks that can take you places you've never been before. These are marks that can take you places you've never been before. This will be kind of a bridge, right? For you to cross on the other side, for you to cross to Canaan, for you to cross to Canaan. So, Mwalimu is saying that when you are preparing for your exams, make sure as at the end of the day, you're perfect in these 5 topics. Not good, be perfect on these 5 topics. I know probably you might say like now we have very little time remaining, but I'm telling you this for sure. If at all you've mastered these 5 topics and of course you supplement it with theory, you're just good to go, right? You're just good to go. That's the secret that Mwalimu is giving us. That's the secret that Mwalimu is giving us. So in addition to that, of course, you'll also be talking of topic number 6. Topic number 6. Topic number 6 is all about financial risk management. Financial risk management. Financial risk management. This is basically in topic number 6, financial risk management. Basically, what should we be expected to understand in that case? At this point, under financial risk management, you'll find it's all about what? Derivatives, right? It's all about derivatives. It's all about derivatives. You've heard of Black-Scholes method, right? So topic number 6, that is financial risk management, all about derivatives, right? So in that case, talk about topic number 7. Topic number 7, we'll be talking of basically international finance management. International financial management. International financial management. International financial management. The concept to do with the aspect of, I know all of you have had that, right? The aspect to do with the aspect to do with the aspect of interest rate parity, purchasing power parity, talk about international arbitrage. I know you've heard of this concept. So basically, that is what we'll be covering in topic number 7. In talk about topic number 8. Topic number 8 here, we'll be talking about real estate finance. Real estate finance. Real estate finance. Real estate finance. More of a theory. It is more of a theory. Real estate finance. Real estate finance is more of theory. Then talk over topic number 9, which is our last one, emerging issues. Emerging issues. So literally these are the 9 topics that you'll be expected to cover. So we've agreed the first 5 topics will constitute like 70%. It can also go up to 75% of whatever that's going to be tested. Now the remaining 30%, of course, it will be shared amongst these topics that have remained. The 30% will be shared amongst these topics that have remained. More so here, key item, it is in relation to, of course, international financial management. More so in this case, of whatever that has remained, the other 4 topics, that is key. The aspect of derivatives. Nowadays, we are seeing that the examiner will never miss to bring a question in relation to derivatives. Also, in addition to that, financial finance aspect of swap and all that is also very important for you to be able to understand. So the first 5 topics, I'm insisting, these are the must know topics that as at the end of the day, you must be having them at your fingertips. So the strategy of doing this paper effectively is for you to balance, right? For you to balance the theory bit, because remember, like the theory might come almost up to say like 30% of whatever that is going to be tested, like theory 30 to 35%. So also it is very important that you also balance with the theory, because once you balance with the theory, things on our end will be very, very easy. So this is just a summary of what you're supposed to do and the best strategy that you should always be using in our revision. So in this revision period of ours, we have a block model paper which we've prepared. This block model paper has literally, we have our almost 8 questions. These 8 questions will literally cut across all these topics. These 8 questions will literally cut across all these topics. So that by the time you are through with these 8 questions, in this case, you should be very knowledgeable when it comes to almost each area. And in that case, once you have that, you'll find that you'll have kind of prepared a very good foundation for your revisions. Balancing it with theory, which Mwalimu will be sharing the theory question and answers. In that case, it should be very good to go when it comes to advanced financial management. So to this point, guys, thank you so much. Let us meet in our next class, whereby we are going to start with our block model paper, question number 1. Thank you so much. See you then. Hello, learners. Welcome to our session today. I am your instructor, CPA Ringo Frederick. Today, basically, is our second class of our revisions. And remember, you're looking at advanced financial management. Last session, basically, I gave you a hint and basically strategy on how we should always tend to approach advanced financial management. Class today, it is our first session in relation to questions. And we are going to work out our questions. We have 8 questions in our block model paper. Class today, we are going to start with question number 1. And question number 1, basically, these are what you're given. I'm sharing it in our screen. These are question number 1. believing that is very visible on our end. Believing that is very, very visible on our end. I've literally shared it on the screen. So let's check it. Let's check out that question. Let's check out that question. And it will be upon us to identify that it has come from which topic, right? So this is a question. This is a question. We are told that I'm having this company known as Viwanda. Viwanda Limited. You can literally download the question as well. Viwanda Limited is considering purchasing a machine at a cost of 40 million. The company will incur an additional 20 million to modify the machine for special use. So literally that is to say, the cost of this machine, final cost will be 40 the purchase and 20 the modification. So the investment of this machine literally will be talking of how much? 60 million, because it is 40 plus 20 million, right? The machine is expected to have a useful life of 3 years and a scrap value of 15 million after 3 years. So by the fact that I'm given the useful life, I'm having the cost and I'm having scrap value, the whole idea at the back of our mind should be depreciation. Then I'm also told here that the investment will require an increase in net working capital of 2 million at the beginning of its useful life, which in this case, we also told that the additional investment in working capital will return to normal at the end of machine's useful life. So by the fact that I was told that this working capital will return to normal, the whole idea of terminal cash flows should click at the back of our mind. So for terminal cash flows, clearly, I know very well that I'll be having the amount that I'll be receiving in relation to basically the scrap value, as well as the working capital that you're going to recover. So that should take us to the concept of what? The terminal cash flows as at the end of the period. That is very important to note. So just by that information, literally, we can know we are heading where, right? The machine purchase will not affect revenues, but it is expected to save the companies 25 million each year in before tax operating costs, mainly labor. So I'll be having a savings. These savings will act like our cash flows. These savings will act like our cash flows. The corporation tax rate is 30%, and the company's cost of capital is 10%. Required, advise Viwanda Limited on whether to buy the machine. Note 2, suppose the firm's management is unsure about the savings in before tax operating costs, carry out a sensitivity analysis on this variable, assuming that the variable shall vary adversely by 10%. My good students, given such a question, it will be important for you to identify it is coming from which topic. Yes, you're having sensitivity analysis. Then I'm given the concept of advising this company. So the whole idea here, we are advising the company based on the capital investment. So you should click, or rather, you should click at the back of your mind straight that you're dealing with a question from capital budgeting, advanced capital budgeting decisions. Advanced capital budgeting decision. That is what should always tend to come at the back of our mind. So once we know that, I'll want to take you briefly through the advanced capital budgeting decisions, right? More so, the techniques that we normally tend to use in conducting our basically capital decision or capital investment decisions, okay? So looking at the techniques, my good students, before we look even at that question, let us go back to the roots. Looking at the techniques that we normally tend to use, we normally tend to have what? We normally tend to talk of two techniques. Number one, discounting techniques, or we start with non-discounting techniques. So number one, we are having non-discounting techniques. Non-discounting techniques. And number two, we are having discounting techniques. Okay. Breaking it down. Now, discounting techniques we normally tend to talk of two. That is, number one, payback period. And number two would be accounting rate of return. Okay. Discounting techniques talk of the main four. That is, number A, net present value, commonly known as NPV, internal rate of return, IRR, profitability index, PI, discounted payback period, discounted payback, discounted, of course, a payback period. So these are the techniques that you normally tend to use in basically conducting our capital budgeting decisions. This from there, that is where we normally maybe aspect widen them further into sensitivity analysis and all these concepts. But these are the root techniques. So in this case, mainly, we normally tend to use discounted. Many a times, whenever we are talking of the aspect to do with capital budgeting decision, because remember the concept of present value, our cash flows, present value. So most ideal methods, or the one that are always commonly used, net present and profitability index. At what point will you be expected to use profitability index, my good students? At what point will you be expected to use profitability index? These are situations where we are dealing with replacement decisions, or where I am having capital rationing. These are where we normally tend to use many a times the aspect of profitability index, PI. Most of the cases for capital investment decisions, we normally measure or compare our net present value to determine the worth or viability of our project or investment. If at all in future, of course, you'll be having profit or loss in relation to the same. So that is where we normally tend to use what? The net present value, which we're referring to as NPV. So in our question, clearly, we can see it is capital budgeting decision. And in that case, I'm not talking of replacement decision, or we are not talking of capital rationing. We are looking at a concept whereby we need to determine if it is wise for us to invest in that project or not. So therefore, that will take us to the net present value. You see, we are breaking that question to the point that we know what exactly we want to do. So after this analysis, therefore, you will find that it will be important now for us to consider the following. We've agreed that I'll be talking of our net present value. Breaking down net present value, we should always be having the present value of cash flows minus our initial outlay. That is in the event that I am not having the terminal cash flows. Where we are having our terminal cash flows, our NPV therefore will be present value of our cash flows. We add present value of our terminal cash flows that is as at the end of the period, we less our initial outlay. Very important. The cash flows that you're talking about here, these cash flows that we are talking about here, these are annual net after tax cash flows. And how will you determine the annual net after tax cash flows? Annual net after tax cash flows. We normally tend to talk of our cash flows here or profit before tax. Okay, we less our tax, we add our depreciation tax shield, DTS. Where in this case, my good students, you should understand that DTS, depreciation tax shield, we normally achieve that by taking our depreciation here, we multiply by our tax. That should give us depreciation tax shield. So the first segment of cash flow. What about the other segment of present value? Present value, it will depend. If you're having lump sum or if you're talking of annuity. Lump sum in this case is the same as irregular cash flows or lump sum value. Annuity, this is regular cash flows. Same, equal all through. So at this point, whatever that we should be having in this case, it will be upon us basically to identify the present value factor. This is the key item, present value factor. Where present value factor for lump sum, we normally tend to talk of 1 plus R raised to power negative period N. Present value for annuity, we have 1 minus into 1 plus R raised to power negative N. We divide by R. Very important. Very, very important. So that is to say, for us to determine our aspect here, this is a, remember, this is a present value interest factor. This is present value interest factor, annuity, given rate, number of years, given rate, number of years. So that is to say, if at all we were to determine therefore my NPV, depending on the situation that we're having, I should be having present value for cash flows. So to determine our present value for cash flows, I'm going to take my cash flows annual net after tax cash flows. Annual net after tax cash flows. That is what you're talking about. Annual net after tax cash flows times my present value interest factor or interest factor annuity, given the case, our R and N. then let's what? Our initial outlay. So this will give us our net present value. We've broken it down up to this point. So that once you have this in your fingertips, you'll find that things will be very, very easy now on our end, understanding each and every concept. So doing this, it has literally given us a summary of what I should always be expected to have, So I can erase this point because we've literally done all the summary. Allow me to erase this. We go to that question of ours. Let me share. Voila, believing that is very visible on that end. I can squeeze it here. So this is what you should have. At this point, I'm given everything of what will guide us. We've agreed that basically to advise this company Viwanda, we are going then to use what? Net present value. To advise Viwanda, we are going to use the net present value. So my net present value in this case, I should be having present value for cash flows, which in this case is our cash flows, annual net after tax cash flows, of course, times what were we having as our annual cash flows. If you check that statement here, you're told the machine purchase will not affect revenues, but is expected to save the company 25 million each year. So it is like that saving is our cash flow each year for how many years? 3 years. So that is present value interest factor, annuity. Given our cost of capital, operation tax is 13, the company's cost of capital is 10%. So 10%, 3 years. We are given the working capital that was recovered as at the end of the period. So therefore, we should have our terminal cash flow as at the end of year 3. This is a one-off value, so you're talking of present value interest factor given 10% in 3 years. Given 10% and 3 years. Given 10% in 3 years. So that is what you should have up to that point, right? So in this case, we know very well that I am supposed to deduct what? Our initial outlay. So we have all these items. First thing, determine our present value interest factor, annuity, given 10%, 3 years. We should be having our 1 minus into 1 plus 0.1 raised power negative 3 divided by aspect of R, which is 0.1. This should give us our factor. Remember that bit? I've just looked at it when you were starting. So in this case, I should be having 1.1 raised to power negative 3, 1 minus answer, divide by 0.1. This should give me into 2 decimal place, 2.4869. The other item, present value interest factor, given 10% in 3 years, that should be 1 plus R raised power negative 3, which is 1 plus 0.1. This should give us what? 1. That should give us 1.1 raised power negative 3 to give us 0.7513, determining our factors, right? Determining our factors. So the next part will be for us to determine our annual net after tax cash flows. Remember, Mwalimu had already guided us on this, where we mentioned I should be having my cash flows, or profit before tax minus tax plus depreciation tax shield. Mwalimu had talked about this, right? Plus depreciation tax shield. So therefore, I'm going to have our cash flows here. My cash flows in this context, it will be what? The annual savings. This will be the savings that I'll be having. How much will I be having as savings per year? I should be talking of whatever figure that was given there, 25 million. So you're having 25 million. Allow us to put our figures into thousands. What is our tax component? Tax component here, a good examiner had given us 30% times 25,000. This should give us what? 0.3 times 25. This should give us, that is, I'm having a figure of 7.5. I'm having a figure of 7.5. So that my aspect of part 25,000 minus answer should give us 17,500. We add our DTS, depreciation tax shield. So what is our depreciation? Recall, depreciation is always cost minus residual value of our estimated useful life. So what is the cost of this item of ours here? The cost, in this case, we are given depreciation tax shield. I'm having the cost. The original cost of this machine, we had 40 million, right? Because that is, of course, exclusive of that additional item for the purpose of depreciation. I'm having 40 million. What is our residual value? Residual value are given in the second statement, where the machine is expected to have a useful life of 3 years and a scrap value of what? 15 million. So scrap value here is 15 million. We divide by the estimated useful life of 3. We multiply by what tax rate? 30% to determine our depreciation tax shield. DTS, remember I talked about this. So I'm having 40 million minus 15 million divided by 3 times 30. This should give us a figure of, I'm having basically, that is a 2, that is a, of course, I'm having 60, that is times 30%. So we have multiplied by 30. So that is 40,000 minus 15 divided by 3 times 0.3 should give us 2,500. That's the figure that I'm getting. You can confirm. We are getting a figure, of course, of that much. That is 40 minus 15. Was that not really? This was a 40 plus 20, right? Remember the initial cost. If at all you can work it out correctly, we're having the 40 million. This was the original cost, 40 million. We add the modification, which was 20 million as per what you're given. So literally we are talking of 60 million, right? So literally we are talking of 60 million. So this is 60. Kindly correct that. That is 60. So that we're having 60 minus 15 divided by 3 times 0.3 here. So I'm having 4,500. We add. Kindly correct that. Because remember that statement is telling us that we had 40, the value of our cost, plus 20, the initial, or rather the modification cost. So I'm having 4,500. So what will be our total value here? Our annual net after tax cash flows, annual net after tax cash flows, I should be having that value, which is how much? 17,500 plus 4,500. This should give us 22,000. So that is what Mwalimu is getting. Kindly confirm with what you're having. So we have determined only but one component, which was what? The first bit, right? What about the terminal cash flows? How will you determine your terminal cash flows? That will always be easy. Your terminal cash flows will always be determined by taking your residual value as at the end of the period. So you take your residual value at the end of the period. This is salvage value. Okay. Salvage value in this case, you add the working capital recovered. You add the working capital. You add working capital recovered. This will give us our terminal cash flows. So the salvage value was 15. The working capital recovered, we had 2. Remember, our figures are in thousands. This will literally give us what? 17. This will give us basically 17. 17. That will give us basically what? 17. That will give us a figure of 17. That will give us a figure of 17. So work it out. So once we have that, these are what we should be having. Right? These are what we should be having. Our initial cost, the final value now. Right? Our initial cost. What will be our initial cost? The initial cost, this will be easy because my initial cost, of course, here, the one to be used as our initial cost. Sorry, let me erase that. Initial cost here. That will be very easy. And why is Mwalimu saying that this is easy? Because see, I'm having our purchase cost. We are having our modification costs. Because we had a working capital that we are incurring, again, additional working capital. Additional investment of working capital will be required, which is what? 2 million. So I'll be having what? Additional investment, which is what? The working capital investment, working capital. So this should give us our initial cost, initial outlay, right? So we're having the aspect of 40 here. Recall the 40. I'm having modification 20. Working capital, the one that we incurred at first, then you're going to recover, is 2 million. So if we are to talk for initial cost, therefore, I should be having the value of how much? I should be having the value of 62 million here. 62 million. So once we have that, we have everything. We can now literally work out this question of ours. So we start with our cash flows, right? We start with our cash flows, present value for cash flows. So we start with our cash flows here so that you see how easy this will be, right? So my cash flows, therefore, I should be having present value of our cash flows, PV of our cash flows, PV of our cash flows, present value of our cash flows, I'm having our 22,000, the annual net after tax cash flows, right? 22,000. We multiply by the present value interest factor, which we had it here, 2.4869. We come and have our present value of our terminal cash flows. Terminal cash flows, 17,000, which you have determined, times our present value interest factor, because it was a lump sum value, which is what? 0.7513. So this should give us how much? Then we proceed and less our initial outlay. Initial outlay, we have determined it to be 62 million. Initial outlay. So therefore, my NPV here will be how much? Our NPV, we should be talking of how much. That is what you are supposed to basically determine. And I know in that case, you can literally give Mwalimu the value of that. So in this case, we should be having, that is of course my value, which is 22,000 times 2.4869, 54,711.8, 17,000 times 0.7513, 12,772.1. So plus 54,711.8 minus 62,000. This should give us my net present value to be 5,483.9. So this is what I'm having as our net present value. So therefore, being our net present value, of net present value is positive. So how can we advise this management? Of course, they should proceed and invest in that project, because I'll be having a net present value of what? Net present value of a positive net present value, which is 5,483,000. So that is what you're expected to do in that part. You can always ask your question, guys. So after we're done with that, let us proceed to the next bit. What were we told? The next item here, if you can check our question clearly. The next item here, if you can check our question. Part number 2. Part number 2 is telling us what? Part number 2, our good examiner is asking us, suppose the firm's management is unsure about the savings in before tax operating costs. Carry out a sensitivity analysis on the variable, assuming that the variable shall vary adversely by 10%. So we are not sure, and we are looking at it in this case that our variable in this case, which is savings, will be affected by 10%, and basically this will be an adverse effect. This will be an adverse effect. This will be an adverse effect, right? Because you're clearly told that suppose the firm's management is unsure about the savings in before tax, right? The savings before tax initially we had 25, but you are unsure. So you're supposed to carry out sensitivity analysis on this variable, assuming that the variable shall vary adversely by 10%. Shall vary adversely by 10%. So that is simple, my good students. And why is Mwalimu saying that is simple? This is what you're supposed to do. So now I'm going to basically have this question just here. So now what will change? What will change is a good examiner is telling us that this time round, my value, which is cash flows, will be affected adversely by 10%. So in this case, we carry out our sensitivity analysis. So I'm looking at where we are going to raise, because this one you're not going to use it again. So just mark it for Mwalimu. Mark for Mwalimu these values. Mark for Mwalimu these values. Mark for Mwalimu our terminal cash flows. Mark for Mwalimu our terminal cash flows. So that I raise there my terminal cash flows. We had 17,000. Our initial outlay, we had 62,000, because this will not be affected, right? So allow me to erase this point here. So a good examiner is telling us that this time round, what is happening? Whatever that is happening is that my savings will be affected adversely. Our savings will be affected adversely by 10%. So my savings will reduce. So this is sensitivity analysis, right? Remember, in our coursework, we dealt with this concept, sensitivity analysis. We had looked at this concept of sensitivity analysis. So we are saying here that my savings will be affected by 10% adverse. So our new savings will be, our new savings here will be what? I'll be having 25,000 affected adversely by 10%. So that will be 90%. So my new savings will be how much? 25,000 times 90, which will give us 22,500. So my new savings will be 22,500. If our new savings is 22,500, therefore, what will be our annual net after tax cash flows? That is the item that will basically change. Annual net after tax cash flows. This is a new item that I should be having. All these other items will be the same, except for now the component of course, except for the component of tax. Tax is the other item that will literally vary here, right? So conducting that sensitivity analysis, therefore, because you have all these, actually you can erase all these except for factors. So these are what you should be having now. My new annual after tax cash flows. You see, initially we had 22, but things are changing now. So the same concept will apply. My savings now, our savings now will be 22,500. That would be our new savings, 22,500. Right? My tax will be 30% times 22,500, which will give us how much? 0.3 times 22,500, which will give us 6750. So I'm having my tax 6750. That should give us 22,500 minus answer to give me 15,750. 15,750. We add our depreciation tax shield. Depreciation tax shield will not change. Depreciation tax shield will not change, which in this case you had what? 4,500. So my annual net, we should be talking of 15,750 plus 4,500 to give us a value of 20,250. So I'll be having my 20,250 here. Okay. Our annual net after tax cash flows. Annual net after tax cash flows. So once I have that, remember initially this is what we had, 22,000. So what are we going to have here? My present value for cash flows this time round, my present value of my cash flows, I should be having 20,250 times 2.4869, which will give us a value of how much? 20 to 50 times 2.4869 present value interest factor. 50, I'm having 50, 360. Okay. My present value of our terminal cash flows will just be the same. 12,772. Initial outlay will not change, 62,000. Initial outlay. So that is to say, my NPV, that is to say, our NPV, we should be talking of how much? My NPV, therefore, I should be having this figure, 50 plus 12,772 to give us basically 63. That is 63 minus 62,000. That should give us a figure of 1,129,725. Right? Based on what you're having there. So that is, let us do it again. 50, 360 plus 12,772 minus 62,000. That should give us 1132, sorry, 1132. So I'm having 1132, 1132,000. So 1,132. 1132, right? 1132, 1132. Because hours we had in thousands, so see, literally, basically you can just have it the same case, like 1132, like 1132 here. So see the impact. If at all we conduct that sensitivity analysis, what will happen here? What will happen? I'll be having, if we conduct basically our sensitivity analysis, this will be the impact. Initially, I was having our NPV of this much, but our NPV is reducing. Our NPV is reducing. Our NPV is reducing. So literally, how will we advise this company then? How will you advise the company based on whatever that you're having there? Based on whatever that you're having, we can see that it has a negative impact, right? It has a negative impact. It has a negative impact completely. So therefore, in this case, these are what, of course, we should go ahead and advise this company after we have conducted our sensitivity analysis, right? Allow me to erase this point. Allow me to erase this. So in this case, we can literally agree that basically we're having a negative impact, right? So the adverse change in NPV, we should be having what? Talk about the adverse change in NPV here. Our adverse change in NPV, adverse change in NPV, we should be talking of adverse change in NPV. So I'm having adverse change. Adverse change in NPV. Adverse change in NPV. Adverse change in NPV. So we are having basically 2.49. So that is just a moment. So that should give us 1132, right? The one that we have determined, the one that we determined there. So 1132, that is what we're having. So basically, adverse change, we should be talking of our value here, basically to be what? Our original NPV, right? So So I'm having basically our original, this is change to determine our change in NPV, change in NPV, change in NPV, to determine our original NPV minus our new NPV, of course, based on the original, right? Based on the original, based on the original, based on the original NPV times 100. So I should be having original NPV, which was 54.83, or can we take 84? 54.84 because it was 0.9, right? 54.84 minus 1132. We divide by 1130. We divide by 58, 54.84 times 100 here. So I'm having 54.84 minus 1132, right? Divide by 54.84 times 100. Those are very adverse. 79.3, 79.36%. That is very bad, right? So you'll find that in this case, if at all you are to advise then the company, you'll find that meaning that that is a very sensitive decision variable, because 10% adverse change in the variable results to 79.4% adverse change in our NPV. So that is very sensitive, right? That decision is very, very sensitive. 79% is very, very sensitive, right? So basically that is what we are required to do in that question, my good students. Literally, that question actually has assisted us to cover the concept of sensitivity analysis as well as the concept of NPV, and we literally widened it up. So in our next class, my good students, we are going to have our second session, and in that case, we'll be looking at more questions in relation to this. So that would be our block question number 2. Thank you so much, guys, and let us meet in our next class. Thank you.